still with us. Stephen, thanks for your patience, sir. Let's just talk about the optimism. I caught up with Bank of America early this morning. They're looking for 7% GDP growth this year, 5.5% next year. They're looking for 1 million payrolls this Friday. It's hard to dismiss it, isn't it? The numbers could be really big in the next couple of months.
Yeah, the numbers are not only big, but most estimates are low, even though they're very optimistic. I guess my concern is that almost all strategists are fairly positive on the market. Some concern about duration, as we've talked about. My concern is about leverage in the market. But I think we're at a tipping point right now where we're post-pandemic, and we can see problems in the market, whether it's the hedge fund, whether it's the issue in the Suez Canal, whether it's the unionization of Amazon. So there's some caution we have to have out there. But I think the biggest news in the next few weeks is going to be this huge proposal for the infrastructure and tax plan.
Can we talk about the focus on leverage that you just mentioned there? Can you elaborate on that, Stephen?
Well, I think that whenever the market's nearing an all-time high, which it's just had its best 12 months since, I guess it was 1938, there's always a lot of leverage in the system, and that's often not seen. And I wish there was a little bit more coverage about that's the problem we're having with the hedge fund and poor risk management with the banks in terms of covering that. This was not a complicated situation. This was pretty much a leverage equity exposure that the banks should have been hedged. So I have some concern that there's too much optimism in the market and that there's not enough balancing that with some risk management.
Do you think there will be more balance around the risk management side, Stephen, which actually will lead to some kind of fallout in this market more broadly that goes beyond just this week and the unwinding of this hedge fund?
I think we're in a really unique balance right now. Yes, I think all the banks are probably looking at their risk management. We're in an administration now where there's likely to be more scrutiny, more regulation. The banks, the financial markets are aware of that. I think they'll take that into account. I think looking forward, we'll be looking at a different tax structure, perhaps with capital gains and how companies are taxed. So I think that will be falling into the risk management of analysts going forward.
Bit of a question that comes from political economy, so forgive me, Stephen, but it's linked to markets. This is an administration that wants to support Labour now and not capital. And Stephen, I wonder whether we fully understand what that could mean for financial markets through this cycle.
I'm not sure we do. I think this is something that we really need to think about. If we are to look at the trend in the economy since the early 1980s, the portion of the GDP that is corporate profits has grown over that period of time, and the portion that is wages has shrunk. This administration is trying to reverse that for good or bad, but it does have implications for companies and it has implications for the markets. So higher taxes on companies, higher taxes on capital gains, the idea that we no longer need to encourage capital investment in the way that we have, that there's plenty of capital, in fact, perhaps a savings glut, and so that we no longer encourage capital gains in the way with tax benefits we have in the past is going to have a big change in the markets.
Stephen, we're thinking about this in real time together right now, so work with me just a little bit further. You've got to make a bet on the issue of whether they can reverse that, on whether they're going to be successful or not. And as you try and answer that question, what does it mean for the kind of allocation you want to have to this market? Let's say they are successful in reversing some of that. What does it mean for what you want to own through this cycle, through this recovery?
Well, we're going to have a discussion in the next few times we're on the show more about taxes and after-tax returns than we probably have had in 20 or 30 years. So I think investors, particularly individual investors, are going to have to think about their after-tax returns in a way that they haven't thought about that before. They're going to have to look at their current portfolios and see what changes they have to make and how they anticipate future changes in the market. I think how the government intervenes in the market is going to be much more important for companies than it has been in the past. This legislation is actually an industrial policy, and we just have to take it as that, analyze it that way, and look how that's going to affect companies and the economy.
This is really smart, and I'd love to continue the conversation another time with you.